Welcome to the Corporate Treasury 101 podcast. This is the second part of our full conversation with Alex Griffiths, where we discuss ESG in ratings. Alex Griffiths is a managing director and head of EMEA Corporate Ratings at Fitch Ratings. Fitch Ratings is a credit rating agency that rates the viability of investments relative to the likelihood of default. Fitch is one of the top 3 credit rating agencies internationally renowned, along with Moody's and Standard & Poor's. In the episode of today, expect to learn what are ESG factors and why they are important in the credit rating process, the challenges in incorporating ESG factors into credit ratings, how can Treasury professionals effectively contribute to the credit rating process, how does Fitch Ratings integrate ESG consideration into its credit rating process. I really loved our conversation with Alex. He truly is passionate about his topic and extremely fast on answering our very intricate questions. We hope you will enjoy the episode. If that is the case, and when you're thinking about how you found out about our podcast, chances are that it was through word of mouth, social media, or a recommendation from your favorite podcast platform. And this is our only request to you. The only way we can get more and more amazing guests like Alex and get more people to learn about Treasury is thanks to you. So if you enjoy what you hear and maybe learn a thing or two, please consider following the show, leaving a review, or sharing this episode to help others discover it too. With all that being said, please welcome Alex Griffiths. We would like to dive a little bit deeper into the role of ESG in credit ratings. So maybe to begin with, can you explain what ESG factors are and why they have become important in credit ratings?
So ESG has been, I suppose, growing up over the last decade or so as a broadly discussed concept. If I look back at maybe the history of how Fitch was thinking about this, when we were looking, I suppose, mid last century, ESG was being talked about quite a lot. And a lot of the concepts that were being discussed were things that we were already doing. So governance, for example, has always been a massive part of our criteria and our thinking, particularly having an impact in emerging markets usually, but sometimes in developed markets as well. So our first thought about this was, well, we're actually doing quite a lot of these things. How can we make it clear to everybody what we're doing? So, the first thing the market was asking for was, you've got your credit ratings. How do you include ESG in that? So our first step, and it happened in 2019, was to produce what we call ESG relevance scores. So essentially, what we do is we say, okay, we just concluded on the ratings, the end of the committee. We've got 14 specific ESG factors that we think about. Did any of these specific factors have a material influence on the rating? And so it's an observation on what we did. It's not new criteria telling us what we should do, but it allows us to sort of step back and think what ESG factors were in here. The way that we score it, we have a 1 to 5. So 1 is, this factor, it's just completely irrelevant for this sector. So, suppose water usage in airlines is an example. Obviously, you could find a tiny tangential way, but it's not in any way a major issue. And then it gets to 3, which is the middle, which is this issue is potentially important, but also it's under control. It's not having an impact yet. So there's a theoretical issue here, but the issue is controlling it. Then you get up to 5, which is, okay, an ESG factor we've identified specifically changed the rating. So you have that gradation. 4 is there's a material impact. So essentially it was part of the rating construction, but not something which changed the rating by itself. So we've scored on that 1 to 5 basis. That was essentially looking at what we were doing and highlighting what's important. Because, as we discussed, in the last podcast, the bulk of what we do is trying to understand the business, understand all the various risks, there's no sort of checklist of what we're thinking about. It's trying to understand the thing holistically. So if there was a problem with wildfires, that's in the ratings. In fact, some of the fives that we see in the US, for example, at the moment, are just down to wildfire risk. So we should have picked up all those risks anyway. We came along with that for quite a long time. And if we look at the various ES and G factors where we have an impact, whether it's a 4 or a 5, about a quarter of ratings are impacted by some sort of ESG factor materially. The biggest of those is governance by quite a long way. So as I said, governance affects emerging markets. It can affect developed markets as well if it's not up to scratch. It tends to be a negative rather than positive. So, if governance is fine, that doesn't necessarily raise a rating, but it can drag a rating down if it's not fine. Second, you have social factors, which change markets. And then only finally do you get the environmental factors. So about 6% of our ratings now have an elevated environmental factor, which when you're sitting there thinking about climate change and climate policies feels incredibly low. What we therefore tried to do was think more about climate, because climate is a weird thing to get your head around in terms of credit ratings, because we tend to think about, we don't have a fixed rating horizon. So in theory, our horizon is infinite. Practically, though, we do tend to focus a lot more attention on things that are better understood, more certain, which means shorter term. So our forecasts are 3 to 5 years, for example. Things that are going to occur in that period have a lot more weight than things that are going to be 15 years out, for example, which is where climate's a problem, because a lot of these changes don't tend to have an impact on the companies we're looking at in any material way in a short period of time, in that sort of 3 to 5 year period. So we wanted to think about doing two things, really. One was making sure we were capturing all the risks, and the other was giving investors a signal of what's out there in the longer term. So even if something isn't included in the credit rating, let them know that it's out there so they can start making their own judgments as to whether they think in their analysis it should be. Because credit is only one part of a pricing decision. There's also market aspects which could potentially cause pricing to move before credit becomes a real issue. There we've come up with our climate vulnerability signals, which started off a few years ago as a series of reports looking at sectors. We've now started doing them for companies earlier this year, so we're probably about halfway through scoring up the portfolio as we speak. And that's a scale of 0 to 100, where the middle of that scale, so 50, will tell you you're expecting, or if the company doesn't do anything to mitigate the risk, you could have maybe a 1-notch downgrade, roughly, of that company by the year that the score is set. So each of these is not just a point in time score, it's a curve. So it shows that build up. So if you're an investor and you're concerned about what's happening to your risk 25 years out, you can look at the end of the curve and see that. If you're looking, if you're concerned only about 5 years out, you can see that too. The signal will tell you what the potential risk to the rating is at that point along the curve.
So it's mainly focusing on the actual risk. Is there any notion of saying, especially with how the world is evolving lately, around saying more, okay, this company really doesn't do any effort on whatever it is, E, S, or G. Therefore, they should be a bit penalized when you look at the cost of debt, basically? Or is there not such a notion here?
This was a big, and still is a big point of debate in the market. What should credit raters, others do, and what should they include in their methodologies? Our view has been, we do credit. We understand credit. So the vulnerability signal only looks at the potential credit impact of these events. Obviously, you can do an awful lot more if you start thinking about the broader impacts, and typically it's referred to as impact. All the other work that is done around ESG as to whether the company's doing good, its impact on society, the economy, on people. But we need to be, or we are quite clear as to where our role as a rating agency sits, which is purely we're looking at credit. Now, we do have another part of the business called Sustainable Fitch, which specifically looks at those broader factors of impact. We have our clear lines, but as a company, we are thinking more broadly about this. And as I say, some of those things can be important because they could potentially at some point start influencing pricing and things in a different way. But we are focusing on credit. I mean, there's more I can say on vulnerability signals if you'd like to ask.
I was going to ask a question. I was going to ask a very quick question on it and maybe put you on the spot a little bit.
Yeah.
So Alex, put you on the spot a little bit. So I'm looking at the vulnerability score right now, or the signals across industries.
Signals, thank you. Yep.
Sorry, yeah. So interestingly, it says that wind and solar and electricity networks are going to be unaffected over the next 20, 30 years. I would assume that the vulnerability of those industries would be steady. That makes sense, meaning that they're not going to change in investment risk over time. Is that what it's trying to say? Because I see things like oil production going up in terms of vulnerability. I see things like petrochemicals going up, although albeit slower.
Yeah.
So the way to read it is over time, things like oil production, petrochemicals, coal generation are going to are more likely to be vulnerable as to climate change over time. Whereas electricity networks and solar you're saying, aren't going to be affected at all. Would they not get better as investment opportunities?
Essentially, so we are, we're all about risk. So we're trying to measure the downside risk. So we're not going sort of negative and measuring potential upside. What we've defined 10 as is, there is essentially that there is no negative impact from climate transition, and in fact, there might be a positive impact there. We're not trying to, we haven't gone the other side and try and quantify the positive. Obviously, if you're doing solar and renewables, then you are getting probably a tailwind from the transition. But yeah, that's the way to look at it. So we're not so concerned if it's good. I mean, the reality is that if you look at renewables and other sectors, they have their own problems. So this isn't saying if you look at sectors they're riskless. It's just saying that if you think about climate transition's impact on them, it's neutral or positive at those kind of levels. And albeit something like networks are quite interesting because we're not saying they're not going to be impacted. So, I took the plunge a couple of months ago and put panels on my roof. Now, you can imagine the complication of an electricity network where you used to just pump electricity one way to moving to one where you've got to actually suddenly account for all of these random little bits of generation all over the place, contributing to the overall flow of electricity. And some of it comes on, some of it is not. Some of it depends whether I choose to plug in my electric car or not. There's a lot of investment required, but typically these sort of companies get remunerated based on their investment. So they should be in a reasonably good position if they're forced to expand. But no bones about it, there's going to have to be a lot of work done by the networks to keep things functioning in the new environment.
Yeah, because you're not just factoring the risk of those companies being affected, you're also factoring the risk of the government being able to keep up with micro generation house to house, right? Exactly.
I mean, what's interesting is you picked what I'd probably call the obvious examples in there, which is the renewables on one side, coal on the other. I mean, what's interesting where we think we provide real value is the bit in the middle, which is things like cement. So if we step back a bit, it's really hard to try and do this sort of analysis because one of the first things you run up against is no one actually knows what's going to happen. No one knows what's going to happen sort of 2 years out, let alone 15, 25 years out. So we get around that by just assuming a particular scenario and using that as our benchmark. We've taken the UNPRI's in their policy response, which is it's designed for investors. It's really granular, has a lot of things going for it. It's a 1.8 degree scenario, which provides enough of a challenge that it gives us something to get our teeth into when we're looking at how well sectors have to change to cope. So we take that scenario, but the important point is we give it to our analysts. So these are, you remember, people who focus all their attention thinking about and looking at sectors all the time. So we give them that analysis or that scenario and say, okay, what's the risk to your sector under this scenario? And that's a question that they can essentially answer because, we usually give them a macro scenario and say, okay, if this is going to happen, what happens to your sector? So they can do that with a broader climate-based assumption. And it generates the obvious stuff, as we said, that, renewables do quite well, coal-fired power stations don't do so well. But somewhere in the middle, you've got the things like cement. And cement's really interesting because cement generates about 8 or 9% of the world's CO2 emissions, right? It's hugely greenhouse gas generating. But if you think about a scenario where you have potentially, more extreme weather, you need to build out electricity grids, as we were just talking about. You need to invest in loads and loads of different infrastructure. Then you're going to need an awful lot of cement to do that. So actually, the price elasticity of demand for cement is very, very inelastic, which means that if they've got to pay for their carbon, if they've got to invest in experimental new processes, they'll be able to pass a lot of those costs on to the end customer. So cement ends up actually somewhere in the middle. So they're going to have to do an awful lot of work, but there's no fundamental threat to the cement industry that we can see.
Yeah, you've also got some other interesting industries on there like gaming and gambling and stuff like this, which I couldn't access because I need to make an account, which maybe I'll do later. But people can go on the website and we'll put the link in below. Bringing it back to Treasury and traders, Alex, if I'm a treasurer sitting in one of these companies that perhaps has a high vulnerability signal, trying to get the wording right, not score, signal, how would I react differently as a treasurer to try and improve or to try and work towards putting my company in the best position? So how should a treasurer take it? Okay, if I'm a treasurer sitting in let's say a petrochemical company versus sitting in a wind turbine manufacturing company, how do I react to these differently?
A lot depends on how integrated the treasury function is in the rest of the architecture around ESG. So we see, when I speak to fixed income investors, we see loads of different organizations and ways of thinking about ESG within them. Within companies, I'm sure it's even more diverse how they consider it. But if you've got a head of sustainability, then I would expect a treasurer to be fully on board with what was being discussed, what the plan is. Be able to think about that in the broader context of financing, explain it. Because I think everybody nowadays that's being talked to, or that's involved with external parties, they'll be being asked about ESG. It would seem obvious that everybody should be able to discuss it, particularly if you've got those external facing roles. I think the point at which anybody in an organization can think that ESG is sort of somebody else's problem is long past. And obviously, the sort of questions we will be asking are, okay, your transition to green steel, and you say you're going to do that by 2030, how much is it going to cost? So make sure that information is surfaced in a way that external parties can potentially understand. So, it just comes down to that point that, the better treasurers we work with and the better teams we work with are transparent. It seems to be a formula that is more effective in communicating than not.
Because typically when we talk ESG in total, and we've talked a couple of times previously on the podcast, the G, and you mentioned it before earlier as well, the G is really where companies internally can have the biggest influence on, is their internal governance as well. A little bit on sustainability, like making some changes internally that will help them be more sustainability conscious as in terms of their impact. So if you just talk very quickly as well about the G side of things, how can treasurers do that will typically give them a better rating in terms of their governance? Just for the people to understand how treasurers play a role there.
Yeah, so the companies that we look at where we assess governance, the governance tends to be beyond the treasury to an extent. So what we see is there tends to be sort of an overarching governance. The treasury is usually part of that. Your listeners will know all the good things you're meant to do as a treasury manager in terms of where you can park your money safely, having strong policies, And frankly, you know more about it than I do. So a company that generally has good governance will generally have that sort of discipline in place and that sort of professionalism in place. We rarely sort of downgrade or take a view based purely on what a treasury function is doing, because it tends to be more pervasive. If the rest of the governance is weaker, then usually that's reflected in a less professional treasury. They tend to come together. So, you know, specifically, I suppose the treasurer's role in this is essentially making sure that they can discuss their policies, have clear policies in place, they follow them, but also can talk more generally about governance and organization. Again, it's that role of a funnel, making sure that the information flows to the rating agency.
Relationships again, that seems to be the key factor here. For you as the rating agency, Alex, what are the challenges of incorporating ESG into your rating overall? So we touched on like the typical long-term impact of it versus, you know, that's not very controllable, and why you want probably to be looking 3 to 5 years out, where climate change is probably longer term than that. What other difficulties do you have incorporating ESG into your credit rating scores?
It really is it's that time horizon question, and the way that we've thought about that, and we've thought an awful lot about it, is to use the vulnerability signal as a means of telling us, okay, in 15 years there might be a problem. Do we have to, you know, what's the nature of that problem? Do we see that raising its head already? So, you know, for us, it's about trying to understand well in advance what some of these long-term trends are and reflect them at the earliest possible moment, albeit that may well be not yet. So in a lot of industries like oil, we're not seeing an impact yet on our credit ratings from climate change, albeit it's something that we're actually talking about quite a lot in our committees now. So it's allowing us to make a conscious decision. I think the biggest problem is simply ignorance. It's if you miss something, because you know we've got the Paris ratchet coming up, which is a process that was put in place during the original Paris Agreement, where the governments agreed that they would start assessing about now whether they had the right policies in place to meet the Paris goals. If they don't, then in 2025, which is the date of the ratchet, they will ratchet up their policies to make sure they meet it. Obviously, politics is politics, and you know, don't want to get into what's currently going on with COP processes, etc. But that's the broad timetable that's still sort of in force and has been laid out. So, if that all works as planned, you would expect to see a pretty rapid acceleration of policies in the second half of this decade. So the sort of traditional, you know, wait and see what those policies might be approach isn't really going to cut it, because they're going to be coming very, very quickly, and you need to have thought about them in advance. So yeah, avoiding ignorance, really thinking about it and making sure you've got the visibility on when those risks are starting to pull forward from the future into something we need to think about today. Those are the real challenges.